Hello, and welcome back to Trust Talk, the podcast from Truss Financial Group, where we break down mortgage options for borrowers whose finances do not always fit neatly inside the traditional lending box. I'm Jason Nichols, your host and CMO at Truss Financial Group.
And I'm Jeff Miller, CEO of Truss Financial Group. It is good to be back. At Truss, we specialize in non-QM mortgage solutions designed for self-employed borrowers, real estate investors, and homeowners looking for more flexible ways to qualify or access their home equity.
Let's begin. Jeff, today we are talking about something that every real estate investor needs to understand, but honestly, most of them do not fully grasp until it either gets them approved or gets them denied. The DSCR value, debt service coverage ratio.
And I think you specifically mean what the difference is between a 1.0, a 1.15, and a 1.25 DSCR value, because those three numbers can completely change what you qualify for, what rate you get, and how your deal gets structured.
Yes, if you are an investor or you are thinking about becoming one, this episode is going to save you a lot of confusion. Let's break it down. Jeff, let's start from the beginning. What is DSCR and why does it matter for real estate investors?
DSCR stands for Debt Service Coverage Ratio, and in plain English, it is just a way of measuring whether a rental property generates enough income to cover its own mortgage payment.
So it is the property qualifying for the loan, not the borrower.
Exactly. And that is the whole beauty of it. With a conventional loan, the lender is looking at your personal income, your tax returns, your W-2s, everything about you personally. With a DSCR loan, they are looking at the property.
And that is a game changer for investors whose personal income looks complicated on paper.
Yep, completely changes the game. A real estate investor might own 10 properties, have significant write-offs, and show very little taxable income.
But if their rental portfolio is cash flowing strongly, a DSCR loan lets them keep growing without hitting that wall. So how is the actual ratio calculated?
Simple formula. You take the monthly rent the property generates and you divide it by the total monthly mortgage payment, including taxes, insurance, and any HOA fees. That number is your DSCR.
Give us an example.
Sure. Property generates $2,500 a month in rent. The total monthly payment is $2,000. You divide $2,500 by $2,000 and you get 1.25. That is your DSCR.
And doesn't a higher number in DSCR mean it is better?
A higher number means the property is generating more income than it needs to cover its debt, which means less risk for the lender and better terms for the borrower.
Okay, so let's get into the specific numbers because this is where it gets really practical. What does a 1.0 DSCR mean?
A 1.0 means the property is breaking even. The rent covers the mortgage exactly. Dollar in, dollar out, no cushion.
Is that good or bad?
It depends on the lender. Some lenders will approve at 1.0 because technically the property is covering itself, but the terms are going to reflect that tighter margin. You might see a higher rate or a larger down payment requirement because there is no buffer if the rent drops or you have a vacancy month.
What about 1.15?
1.15 means the property generates 15% more income than it needs to cover the debt. That is a meaningful cushion. Most lenders start to get comfortable at this level. You are going to see better rates and more flexibility in how the loan gets structured.
And 1.25?
1.25 is where lenders really open up. The property is generating 25% more income than the debt requires. That is a strong, healthy investment. At this level, you are typically looking at the best available rates and the most favorable terms. Some lenders reserve their most competitive pricing specifically for DSCR ratios at or above 1.25.
So the ratio is basically telling the lender how much room there is if something goes wrong.
That is exactly it. If you have a 1.25 and your tenant misses a month, you have built-in breathing room. If you are at exactly 1.0 and your tenant misses a month, you are covering that mortgage out of pocket.
And that risk is priced into the loan.
Always. Every decimal point of that ratio has a financial consequence on the terms you are going to get.
Jeff, let's talk about how we handle this at Truss because I know we have some flexibility that a lot of lenders do not have.
We do. At Truss, we can work with DSCR ratios as low as 1.0 on the right property and the right profile. And in some cases, we even have programs that go below 1.0 for investors who have strong overall financial profiles, even if one specific property is not fully covering itself yet.
Which is huge for investors who are in a value add situation. They bought a property that needs work, rents are going up, but right now the numbers are tight.
Exactly. We are not just looking at the ratio in isolation. We are looking at the full picture, the market the property is in, the investor's track record, the trajectory of the rents. A sophisticated lender looks at all of that.
And the process itself. How fast can we move on a DSCR loan?
Much faster than a conventional investor loan. No personal income verification, no tax returns. We are looking at the lease agreement, the market rent, and the property financials. That removes a huge amount of the documentation burden and speeds everything up significantly.
So, an investor who finds a deal and needs to move fast is not waiting 60 days for a conventional approval.
Not with us. Speed is part of the product.
All right, let's wrap this up. If someone is looking at a rental property right now and trying to figure out if it qualifies for a DSCR loan, what is the first thing they should do?
Run the numbers on the property before you even talk to a lender. Take the expected monthly rent and divide it by your estimated total monthly payment, including taxes and insurance. If that number is at or above 1.0, you have a conversation worth having. If it is at 1.25 or above, you are in a strong position.
And if they want to run those numbers with someone who actually knows DSCR loans inside and out,
TrussFinancialGroup.com. Get a quote, see your options, and there is no impact to your credit score.
perfect. Thanks for tuning in to the Truss Financial Podcast. Subscribe so you never miss an episode, and we will see you on the next one.